Welcome to the WTR Small Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. Today, I'm pleased to be joined by Joseph Lucosky, Managing Director of Lucosky Brookman, LLP. If you've spent any time around the microcap market over the last several years, you know this environment has changed dramatically. The IPO market looks different, the exchanges are behaving differently, regulatory scrutiny has increased materially, and the path to becoming public has become significantly more selective. Joe and his team at Lucosky Brookman have taken a very unique approach to understanding those changes through LB Data Desk, where they track virtually every microcap IPO, uplist, crosslist, direct listing, and reverse merger transaction in the market. The data from the first quarter of 2026 tells a story that I think has caught a lot of the market off guard. So today we're going to walk through those numbers, discuss what's actually happening beneath the surface of the market, and talk about where things may be headed from there. Joe, thanks for joining me today.
Tim, thank you for having me. Look forward to our discussion about all things microcap and all the changes in the regulatory phase and the microcap markets in general.
Definitely no shortage of topics on that front. So, Joe, I believe that Lucosky Brookman might be the only law firm in the country, perhaps even the world for that matter, that has systematically tracked every microcap IPO, uplist, crosslist, direct listing, and reverse merger transaction in the market. Tell me a bit about that data-driven approach, which, by the way, I think is very clever, and what led you to do that in the first place.
Yeah, thank you. Really, it grew out of a market need. Back in 2019, 2020, we were doing deals and we kept hearing from bankers and consultants and everyone else that, hey, a deal had to be done a certain way because that's what the market expected or that's what they had done on other deals. And at one point in 2020, we were doing an uplist transaction and the bank said to us, hey, you have to do a really hard reverse split and some crazy percentages. And we just didn't believe it. So we stayed up all night during that transaction and literally looked at almost every deal we could find about the data around reverse splits. And a light bulb went off. And we said, you know what? There's no organized system out there that cares about or tracks the emerging growth or microcap ecosystem. So we started to collect that data. And by the way, that deal ended up very well because we ended up doing like an 8-for-1 reverse split, not a 30-for-1, because we could show systematically through data what the market would accept. So then we brought that to a larger scale. We really started with IPOs. Then we expanded it to uplist and cross list and now direct listings, which are a very important structure in our industry. But the point is this. Nobody really tracks or cares about the emerging growth world. So we took it upon ourselves in 2020 to start tracking this data. And here's the key part. We give it away for free to the ecosystem. We make posts about it. We put reports about it. We bring it to conferences and events. We shout it from the rooftops because we really believe that if we can do our part to help the ecosystem, help the industry do better, make better decisions, use this data to uplift everyone, then that's a positive thing. And really, that's what we've kind of been known for. I mean, there's nobody, I think, better than Lucosky Brookman to know on the ground, in the trenches, details of every deal, every structure, how the exchanges view it, where the market is heading, where it's been, where it's going. And that's really why we do it. And I'll tell you, we see a lot of people copy our data. They make posts, they put it out, they talk about it. I was on a working group call the other day, and the bank started literally reading from our quarterly report. So it's been a fun time, and it's really been nice to give back to the industry.
I'd be remiss if I didn't actually react to that by telling you that I find the data so intriguing myself on some of your LinkedIn posts that I've been reposting your posts. So yeah, they're actually quite interesting and insightful. Let's turn to all of the changes from the exchanges that we have been hearing about. It really feels like a pivotal year for both NASDAQ and NYSE in terms of new rules, new standards, and increased scrutiny. Walk us through what changed and what has come from that so far.
Yeah, so Tim, it really started back in September of 2024. That's really how long ago this whole sort of regulatory change and massive regulatory change started. New York Stock Exchange in September of 2024 imposed a $10 million minimum gross proceeds rule for any microcap IPO. And then NASDAQ a few months later in December of 24 and into January of 25 said, you know what? We're going to one up the New York Stock Exchange and make it a $15 million gross proceeds rule. So you can't do a microcap IPO unless you raise 15 million in a firm commitment underwriting. And what that really means, because you know and I know we're in the market, that really means an $18 million deal because you have to account for the over allotment and the green
Right.
shoe market stabilizing transactions that the bankers like and the companies need. And, that sort of played out for the first quarter, second quarter of 2025. There was still the net income exception where companies with net income could raise less. And then in September of 25, NASDAQ said, hey, doesn't matter if you have net income or no income, everyone needs to raise 25 million. And oh, by the way, if you're a Chinese company, you now have to raise 25 million. That was the beginning of the real hammer coming down from the exchange. And that was all precipitated by a year of volatility. The exchanges, to their credit, they took action to sort of help the process. Now, I'm not sure if what they did was totally incorrect, and we'll see that play out over maybe the next year or two. But they took action because there was a problem with volatility and price spikes and all kinds of other things that none of us want to be associated with in the market. That all culminated in December of 2025 when NASDAQ passed their 51013 discretionary rules. And this was the bomb that dropped. And that really is this now. NASDAQ, regardless if you qualify, quantitatively, qualitatively, on any number or statistic, can now say no to listing your company based on their discretion. So for no reason or any reason at all. And that really has set the standard different for the exchange. The question is no longer, do I qualify for a listing? The question now is, do I belong on the exchange? And does the exchange want me? And of course, from that, New York Stock Exchange again in January, February started changing their rules back from 10 million to 15 million. So now the whole microcap and emerging growth universe is in a very different situation where, being an advocate matters more, not going through the motions, that's not going to work anymore. The whole playbook has really changed because of that, those historical rule changes culminating in December with this discretionary rule.
Fascinating and complex all at the same time. Kind of a nuanced follow-on to that. How much of this, in your view, is about investor protection versus market quality?
It's I think about this question a lot actually because we all want a safe playing field. I do support the exchanges in their new rules to the extent to
Right.
uplift the ecosystem, but you got to balance that with supplanting the judgment of the exchange for the judgment of the market. And it does feel a little bit like this right now because remember, the numbers are down. And I know we're
Mhm.
going to talk about data in a second, so I don't want to spoil that clip for you, but the numbers in the microcap ecosystem are way, way down because of these new rules. And it can't just be that, hey, all these companies are bad and all these companies have bad data or management that
Right.
doesn't qualify or whatever they want to say. The system is glutted up. So I think a lot of it is upgrading and elevating the market. And a lot of it also, if you talk to the exchanges, is investor quality. They really feel the pressure when these deals, mainly from Asia, had risen so sharply after the IPO and then fallen so dramatically within a short period of time. And that does weigh on them. So I think it's a balance of elevating the market and trying to protect investors in these deals.
Okay, excellent. So following up on the discretionary review process, Joe, let's talk about what the first quarter of 2026 actually looked like compared to prior years, because my recollection is the numbers are rather staggering. What stood out
Yeah.
most to you when you looked at the Q1 data?
Yeah, this is a great question. And I've been staring at this now for literally weeks because it is so staggering.
Yeah.
Let's just step back for a second. So in the first quarter of 2025, there were about 40 microcap IPOs. First quarter plus maybe April, about 40 microcap IPOs, 42, 44, somewhere around there. Okay. This year, 2026, with the new discretionary rules, there's been six, literally six. I mean, that is an 86, 87% drop in quarter over quarter from 2025 to 2026. That is shocking. It cannot just be the new rules are in effect and the discretion is being so widely used. Because when you talk to the exchanges, they will tell you discretion is a tool that they needed and it's going to be a very rare occurrence. The problem is it's not playing out like that in practice. And we're in the trenches every single day with both exchanges getting deals cleared. I mean, we're a lot of times issuer counsel, A lot of times we're underwriters counsel, and sometimes we're special counsel, special listings counsel, where other banks or law firms bring us in just for the NASDAQ piece, because aside from us, no other law firms do that. And there's some consultants that do it and have done it for years, but we're just different. We're advocates, we're not processors. The point is this: the market is super tight. And what that tells us, Tim, is that when the IPO market is really being constricted because of these new rules, the market's going to find a way. And that's what's leading to these alternative pathways. If you look at the data year over year, quarter over quarter, uplists are up, cross lists are higher, and direct listings have shot through the roof. That data is very telling. So, the market's finding a way. It's just not through the microcap IPO.
Understood. A granular follow-up to that one is what explains the collapse in IPO volume, yet an increase in average deal size at the same time?
Yeah, so that's really the upgrade in the quality of what the exchanges are looking for. So I've had numerous conversations with the exchanges. Like I said, I talk to them almost every day on many topics. And the reality is they are no longer interested in deals that squeak by or are really doing the minimum. They want bigger, better deals. And if you look at the average deal size in 2025, it was about $8 million. Because remember, then you could still register selling shareholders to get to that $15 million float. You'd have an IPO plus a resale registration combined to 15. You can't do that anymore. The $15 million gross proceeds rule makes you raise at least 15, which we said earlier is really 18 with the green shoe. And the exchanges are saying if you qualify by a dollar or $1,000 or $100,000, we're not going to be so excited to list you. So what we're telling clients and really the market, because the data is showing this, that less is not more anymore like years past, and bigger is better. The elevated deal, the larger deal, and when I say larger, I mean, it really should start with a two, a $20 million deal, $25 million
Right.
deal. Anything higher than that is amazing, but deals aren't going to squeak by anymore on either exchange in 2026 and beyond.
Okay, noted. So moving on, if the traditional IPO market's becoming significantly tighter, what's happening to the alternative pathways, which is really to ask, are uplists, cross lists, and direct listings becoming more important in this environment?
Yeah, that's the fascinating part, and I'll tell you why they're becoming more important. I think a lot of people are missing this in the industry. You have to look at the data and interpret it. So
Mhm.
as the IPO market is getting tighter, and there's only been six, almost 5 months through. I think there was one that priced the other day, so maybe seven now, halfway through May, right? Almost 5 months in, seven IPOs. Yet if you look at the uplist and cross list data, last year there were one or two in each category. This year, there's seven or eight in each category. Now, that's not just a function of companies choosing a different path, because as private companies do an
Right.
IPO, OTC listed companies do an uplist, foreign listed companies do a cross list, and a direct list is really, a different kind of private company. So you're not seeing companies just choosing a different path. What I believe you're seeing is the ecosystem, the community, putting more resources into those pathways because there's an alternative or easier pathway for the exchanges. Because think about it, when you do an uplist and there's some trading history, and there's a little
Mhm.
exception we'll talk about later for uplisted companies that I think should get more attention. And when you think about a direct listing, which doesn't have any sort of shares being fired off on day one like an IPO, it takes some of the risk factors out of the equation for the exchanges. So I think people in the industry feel that, hey, an uplist could be a little bit easier, even though no deal is easy. And a direct list can be a little safer for the exchanges to say yes, because there's no shares being fired off, like an IPO on day one. So as the IPO market is tightened, the industry itself, in my view, has put more resources into these alternative pathways, and you're seeing that play out now in the listings and closings and data.
Okay. And can I safely assume that the fact that they're not subject to the same IPO proceed requirements is one of the drivers?
It is one of the drivers, but even more than that, an uplist can raise still $5, $6 million as
Mm.
long as you meet, what we call the uplist exception, which is if your OTC company is trading an average of 2,000 shares a day over 30
Mhm.
days, for a 30-day period, you can qualify without doing a $15 million raise. Clearly, on a direct listing, there's really no money raised, although I will recognize that most microcap companies do a private placement or a simultaneous private placement with the direct listing. So that is one of the reasons, but it's not so much the capital raise that's the issue. It's that the exchanges don't have to vet an IPO book for deal qualification or concentration or distribution, which is part of what takes so long on these IPOs. Remember, starting in 2022, they started reviewing all of these deal books. Who are the investors? Why are they investing? How much do they have? Is there deal concentration? NASDAQ historically not loved anchor investors. And I know they will say opposite, but in the trenches, it plays out. If you have a anchor investor that is taking a large part of the book, that usually has to be redistributed. NASDAQ won't allow that anymore. So something that was exciting for many, many years can really no longer be done on that exchange. The New York Stock Exchange treats it differently. But it's not so much that they're raising money. It's that the process is a little bit easier and a little bit quicker if you're not raising $15 million or have a true IPO being fired off on day one.
Okay, that's helpful. So one of the biggest themes over the last several years was the rise of foreign private issuers in the microcap market. How are FBIs competing in this environment right now when it comes to getting listed?
Yeah, that is a phenomenal question, Tim. I'm telling you, I spend almost every day talking about this issue because it is so hard right now. So let's look at the data again, because I think the data is very telling. In 2025, there were 134 microcap foreign private issuers from all over, by the way. Mainland China, Indonesia, Malaysia, Singapore, and other places. So 101 foreign private issuers. To date, right now, through May, again, we would expect to see about 40, 45 deals and maybe 30, 35 of them being foreign private issuers. There's been one. So out of the six IPOs, there's been one. And again, maybe one price this week, maybe there's seven now in the data. But the point is, it is extremely difficult for the foreign private issuers to get through the system now, mainly because of the 51013 discretionary rules, where they list 9 factors and they go through all of these things about jurisdiction, your board, where they're located, the rules of your home country, your advisors, your bankers. Were any of your advisors involved in some of the deals that got shut down or stopped trading? There's a whole qualitative analysis and background check now that's going on. And unfortunately, the foreign private issuers are getting the brunt of it. Now, I personally think that's going to open up soon. And we're working with some companies from mainland China, other parts of Asia, and especially Japan to sort of turn that around with the exchanges and really do a good vetting up front, helping the exchanges get through the process. But it is a really, really difficult time for foreign private issues. So I'm not going to say that market is dead, but it is very challenged and slowly opening as time goes on, as the exchanges figure out how to vet those new rules a little bit easier.
You started to allude to it, I think, just a moment ago, but correct me if I'm wrong. You think that FPI activity eventually will rebound?
I do. I don't think it's a reasonable statement for anyone to say or the exchanges to say, and they wouldn't say this, that foreign companies aren't welcome. That would be crazy because there's many, many international companies traded on both exchanges. I think right now what NASDAQ is doing, and New York Stock Exchange has kind of always done this because they've been a discretionary based judgment first exchange, really forever. They treat it differently than NASDAQ. But I do think NASDAQ is finding its own way right now in trying to balance, implementing the new rules, how to get through that process with the, mandate from Washington, which is their main regulator, to make sure bad deals don't slip through the cracks. And right now, they're just sort of finding their way and trying to get deals through the system without using their judgment to decide which deal is going to be good or bad, because that would be crazy. You have to qualify, and when you do, you should get approved. But that's just taking time for them to find their legs on how to approve these deals. So I do think, maybe not in the second quarter, but I think in the third and fourth quarter, you will see the spigot open a little bit more for these foreign companies.
Interesting. So if we zoom back out for a second and look at the broader picture, what is the new normal at the exchanges today, and how are companies expected to navigate that, presumably with a lot of help from people like yourself?
Yeah, yeah. Listen, I will tell you, the old playbook from NASDAQ and the New York Stock Exchange is over. It's out the window. Anybody that tells you that you can clear a deal like you were able to do last year or back in 2021 or 2022 doesn't know what they're talking about. Anybody that says, "Oh, I know someone at NASDAQ," or "Don't worry about it, just complete the application," that is gone.
Right.
This process has become so much more of an advocacy play, a proactive endeavor. Before that, and that's why, honestly, we're getting hired by a lot of law firms as special counsel. Deals that are in progress. Deals that are starting now. I think we're really in a prime position because we handle the NASDAQ and New York Stock Exchange clearance process versus them having to go out and hire a consultant or, God forbid, just let their counsel who doesn't really do this stuff
Right.
wait because you'll be waiting forever with the exchanges. So right now, being an advocate, being proactive, pushing the envelope, pushing the system, being on top of that process is so important. You can no longer exist, in my opinion, in this market if you're a paper pusher, a box checker, or just going through the motions. The exchanges are too hard, the process is too difficult, and that's why I think Lucosky Brookman is really, really making a push to the front of this industry because not only do we have the data, we have relationships with the exchanges, and we actually understand what they're looking for. So again, we're not magicians, we're not perfect, but from a perspective of pushing the envelope and being proactive and getting a deal cleared, I don't think there's anyone else that has figured out this system better than us. And the data shows it. In the first quarter, there were 5 IPOs. We did
Hmm.
2 of them, literally 2 of them, including the one that broke the 78-day NASDAQ drought. There wasn't any IPOs for 78 days. We did the first one. I mean,
Crazy.
it plays out in the data as well. So it is a totally different ball game with the exchanges right now.
So, interestingly, at Water Tower Research, we routinely talk to private companies, and in fact, I've actually had a handful of private companies on this podcast. So I know that they would love to hear your answer to this. What does a truly listing-ready company look like in 2026?
Yeah, so this is a topic of great debate in the industry too. So let me step back for a second. I'll say that, depending on the size and scope of the company, there's always this disconnect between what we call IPO readiness, which is a great buzzword invented by some large consulting firms, and what I believe the microcap or emerging growth industry needs, which is audit readiness. Because
Right.
most emerging growth companies, they're emerging growth for a reason. They don't have tons of income or crazy, they don't need crazy systems and controls. You need to have an audit, you need to have some modicum of internal controls, and you got to sort of be organized. That's kind of IPO ready in a sense, not in the technical sense, for these larger companies, but audit ready plus, let's call it that. But now, because the exchanges have changed so dramatically, what I
Right.
consider I would add to that, that bucket of readiness is how you're going to get qualified by the exchange. And here's the other thing. What exchange are you going to go on? And let me give you a
Hmm.
reason why that's important. Because I think most times in the emerging growth ecosystem, people default to, oh, we're just going to go to NASDAQ. Because
Hmm.
historically, most
Sure.
companies have gone to NASDAQ in the
Right.
emerging growth system. But that is a mistake right now. And I'm not saying that you have to get away from NASDAQ. I think NASDAQ is wonderful. What I'm saying is, depending on where your company is located, how you plan to raise your proceeds, and a number of other factors, the New York Stock Exchange may be a better fit for you. And here's a perfect example that came up recently. We have a client that is going to go public through an IPO,
Hmm.
and they have 2 really large anchor investors. One is just an institution that is, really knee deep in their industry, right? They're an industry focused institution. And the other investor is a customer of theirs, a very large customer of theirs. So they're going to have out of the gate 2 very large anchor investors that are going to anchor that IPO. Let's say it's for $25 million. Maybe half of that IPO is going to be from these 2 large anchor investors who, by the way, the company's going to celebrate, right?
Sure.
Huge institutional player in their industry and a great customer that they've been doing business with that's a, billion-dollar company. That deal, we would have to give serious consideration if that could get through NASDAQ. Because we know from being in the trenches, despite what they say, despite their literature, they don't like anchor investor concentration. Now, I'm not saying they never do. What I'm saying is they typically don't like it. So, if that's a really important piece of putting together the $25 million, there has to be a serious conversation of moving that company to the New York Stock Exchange, to New York Stock Exchange instead of just defaulting to NASDAQ. So that's what I'm saying. Being ready right now is not like it was in the past. Let's just file an application and we'll figure out along the way. That process is dead.
Interesting. And just rounding that out, Joe, for management teams that might be listening in today, what's the single biggest misconception you think they likely still have about going public in the current environment?
That's funny. I talk about this a lot too. You ask good questions, by the way. These are all the questions I get from the marketplace. I think I think there's a lot of misconceptions and there's a lot of work that people don't see. But this is really a full contact sport now, Tim. No
Mhm.
longer is it just a registration statement, get an audit done, file an application. If you don't have somebody waking up every single day to advance your mission, and I mean like a lawyer, a quarterback, somebody who can not just draft documents and file registration statements, but someone who can lead that process, somebody who can interface with the exchanges, the SEC, FINRA, the bankers, everyone else, that person to move those deals forward, that is what is needed. Because I hear all the time, oh, we're just gonna, file a registration statement and make an application. Yeah, that was the playbook back in 21 when everything worked, and maybe 22. It's gotten significantly tighter. So I think one of the misconceptions is that, hey, the process is, maybe a little longer, maybe a little harder,
Mhm.
but we still can get through it. That is false. It is a full contact sport. We wake up every day and we go to sort of battle in a very friendly, professional way to get these deals across the finish line. Nothing is easy. There is no easy deal. There are no deals squeaking by, and the exchanges are demanding better from all of us in the ecosystem.
What a turnabout. So, Joe, kind of wrapping up here, as you look toward the remainder of 2026, where do you think the microcap market is headed from here?
So I think there's a couple things in play right now. Like I said earlier, I do think maybe not in the second quarter because we're already in May. June is the end of the second quarter. But once we get to the third and fourth quarter, I do think the market will ease up a little bit. And by the way, this isn't a market issue or a money issue. This is purely an exchange issue.
Right.
And here's the other thing that I think is important. There's a huge disconnect right now between what Washington is doing and what the exchanges are doing. Remember, the president, the administration, Chairman Atkins, they're all saying, let's make IPOs great again. Let's, reduce the burden, reduce the regulations, get them through quicker. Well, that only works if the exchanges are on the same page. And right now they're not. The exchanges have been harder, longer than ever in recent memory. So those two systems have to come together in order for the spigot to completely open to help these emerging growth and entrepreneurial companies. But looking forward into the third and fourth quarter, I do think it'll ease a little bit because the exchanges will get a little more comfortable. There'll be a good period of 6 to 8 months of less volatility, hopefully, in the microcap world. And most importantly, the exchanges will have kind of worked out the kinks with these new rules. The other thing I'll say, I really believe that, 2025 was the year of this crypto DAT strategy in the
Right.
microcap. Again, this is
Yeah.
on the secondary side, not on the initial listing side. But there is an intersection that I don't think a lot of people are talking about, and that is this. Because 2025, over 200 microcap companies put digital assets or coin on their balance sheet and a lot of cash.
Mhm.
I mean, this was just a prevalent structure in 2025. I mean, heck, we did 21 of those deals. I mean, it was everywhere. Now, because the crypto market is depressed, a lot of these companies are underwater in their net asset value. Those companies need to look for other opportunities. So when we talk about alternative pathways, uplist, direct list, cross list,
Mhm.
there's also reverse mergers. And I think a
Right.
lot of these companies with all this coin and cash on the balance sheet that are stuck in these low net asset value positions because of where the crypto
Mhm.
world is are going to start looking for alternatives. And that is going to spur the revival of the reverse merger market. Instead of doing an IPO, a lot of companies are going to look to do a reverse merger with companies that had this cash and coin on the balance sheet. And we've been calling them mini SPACs. In fact, I just put out an article this morning on
Mhm.
LinkedIn that I wrote for Forbes calling these companies competing with the SPACs. They're not SPACs, they're mini SPACs. They have less regulation, no redemptions, no trust. They can move quicker. So that's what I really see for the remainder of this year. The exchange is opening up, more deals happening, foreign private issuers starting to get more points on the board and getting approved, and the reverse merger picking up with these companies who have a lot of cash and coin on the balance sheet. Again, an alternative pathway instead of an IPO.
Really interesting. So, just wrapping up, finally, what's the one takeaway you want issuers, investors, and advisors to leave with after today's discussion, Joe?
Well, I think every issuer, every advisor, every bank
Mhm.
needs, a leader in their transaction. There's no more days of being passive, sitting around, waiting, making filings,
Sure.
hoping things will happen. Every day something has to occur. And really, you need a longer lead time because things are happening, deals are getting approved, but they're just not getting approved on the timeline that people want. I mean, we're working on a deal right now that we're expecting approval literally today. We were brought in by another firm who, needed some help, and it's taken a few weeks. And believe me, we've been all over this process. So deals are taking longer, and you really need a leader. You need a quarterback, somebody who's going to wake up every day and push your deal forward. Because again, there's a lot of lawyers out there. There are a lot of good ones, but turning documents, sending red lines, filing disclosures, that's the old playbook. Those advisors are going to go nowhere fast. Every deal needs a quarterback. Every deal needs a leader. And like I said, we are literally at the forefront of this industry and that process with the new regime for the exchanges.
Well, thank you, Joel Lucosky, for joining us today. This was really, really interesting stuff. I'm going to personally invite you back anytime you do a data dump. The fact that I'm reposting them means I mean that genuinely. They're really fascinating. No one else had been doing it prior to your firm. So anytime you put out a new data dump, please come on and talk to our investors about it, and as well as our
Thank you.
issuers.
Thank you. I would love to.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.